Pretiorates thoughts. 76. The market. Flirts with dovish dreams, while bonds start to sweat. Hello and welcome to another pulse check on the markets. Statements from the governments involved, and especially from US President Donald Trump, regarding negotiations on US import tariffs, continue to send shockwaves through the financial markets. This edition of Thought 76 was published just before President Trump announced a potential 90-day suspension of tariffs for countries willing to hold back on retaliatory measures. A perfect example of how markets can turn on a dime. That's exactly why subscribing to our Substack blog matters. In the world of finance, a single hour, not just a day, can make all the difference. Stay informed, stay ahead. Our Smart Investors Action Indicator tracks the behavior of big investors as they significantly influence index movements. By isolating their activities, we create a new price curve. The light blue area highlights the difference from the actual price development. An upward move signals accumulation, bullish, while a downward move indicates selling, bearish. Red areas mark high-volume phases, which we call exaggerations. The stronger they are, the higher the likelihood of a reversal, especially when a yellow dot appears, signaling a key exaggeration point. Following the sharp sell-off across global equity markets, we've reached a level that could trigger a more pronounced technical rebound. The Smart Investors Action Indicator for the S&P 500 is showing a massive exaggeration, an extreme we haven't seen in years. Similarly, the S&P 500's long-term fear indicator has hit a level that suggests most of the willing sellers may have already exited the market. This should ease selling pressure. And when selling pressure drops below the level of new buying interest, prices typically begin to rise again. Sector rotation supports this outlook. In times of economic strength, the discretionary sector, which includes cyclical consumer goods like luxury items, tends to outperform the more defensive staples sector, which includes everyday essentials. Ahead of the major market correction, this ratio dropped sharply, sending an early warning signal. Now, however, it has reached a level that in the past has marked significant market bottoms. The General Sentiment Indicator, a composite of various short-term inputs, has also recently fallen to levels that historically indicate the potential for a rebound in equities. Despite these technical signals, financial markets are increasingly pricing in a global economic slowdown, triggered in part by US import tariffs and geopolitical tensions. Should the economy indeed lose momentum, the Federal Reserve would likely respond with rate cuts. The three lines show the development of market yields with three different maturities. The blue area shows the difference, which can be used to explain the expected yield development on the market over the next 12 months. The bond market has already priced in 4 25 basis point cuts, a full percentage point. Fears of a recession, or even stagflation, have also made their mark on the US dollar and the price of silver. The gold-silver ratio has surged, as silver is being viewed more as an industrial metal than a traditional precious metal. That said, silver may still benefit from any future rise in the price of gold, which tends to perform well in times of uncertainty, especially during stagflation. Should this happen, the strong historical correlation between the gold-silver ratio and the US dollar basket may also reassert itself. Silver therefore has a very high catch-up potential. The ratio between the gold price and the broader commodity index has been rising for nearly 2 years, suggesting growing macro uncertainty. Theoretically, such an environment should also lead to widening spreads between safe and riskier bonds. Fiscal support from the Biden administration may have delayed this, but spreads are now starting to widen, and there's still significant catch-up potential in the bond market. This yield differential, commonly referred to as the U.S. investment-grade credit spread, is a classic risk indicator. The larger the spread, the greater the perceived risk in financial markets. Accordingly, it is closely correlated with the S&P 500. The spread, which is plotted inversely in some charts, is now expanding and setting the tone for equities as well. As with everything in finance, markets move in cycles. One particularly reliable cycle, the 83-month cycle, has held up consistently for over 3 decades. It now points to increasing volatility in the bond market. The short-term Balance of Power Index also suggests that bond yields in the U.S. are more likely to rise than fall in the near future. Conclusion: there are growing signs that storm clouds are gathering over the U.S. bond market. The current flirtation with rate cuts could turn out to be a trap. The bond market is already sweating, and that rarely bodes well for equities. For now, staying on the sidelines might remain the most prudent strategy. Remember that these thoughts are not investment recommendations, but only our opinion. For recommendations, contact your own investment advisor. Don't forget to give us a thumbs up below to help us keep creating this great content for you. And don't forget, if you register directly on our Substack website, you will receive my next thoughts at least 1 day earlier. Check out the Substack link in the description, and best of all, it's free. I wish you great success with your investments and see you for our next market update.